The company has a clear vision. We envision a sustainable world with access to opportunities for all. The way we do this, basically we create products, investable opportunities for different type of investors to basically make available for them investment opportunities which all flow into emerging markets themes. Our ultimate success is that we are not needed anymore. It's not about creating long-term dependencies. It's about creating local systems, and these problems, so to say, are solved. In the impact space, real scale and getting things done faster is a big topic. People prefer to talk about innovation. The thing is, we do not have to be more successful always to innovate. The replication of known approaches is actually something which, as an industry, we are not that good. A company which has a super beautiful impact model, but stays very small, very tiny, can even financially be okay, it's still a limited impact. The biggest impact, of course, to be very clear, is when a company demonstrates something and it is replicated by others.
I'd like to start with a high-level overview of responsibility for people who are not familiar with the company. So maybe keep it at a high level, but start with its mission and investing focus and what asset classes are you investing in and so forth.
Very simple. The company has a clear vision. We envision a sustainable world with access to opportunities for all. That's what we envision as a company. And the mission, like the way we do this, and the wording is, but we create products, investable opportunities for different type of investors, private sector investors, public sector investors, to basically make available for them investment opportunities which all flow into emerging markets themes, the themes which I mentioned earlier. That's what we as a company do, and this hasn't changed over the 20 years now. Company was founded 2003. When I look today we manage $5 billion, to put it at $5 billion US dollar. We have invested over the 20 years more than 15 billion. Yeah. And all goes into emerging markets, or all goes into markets, where still, of course, where you would say, yes, here, the problems when it comes to poverty or when it comes to access to education, to healthcare, are large. All our investments are done in 3 themes, and we typically structure products along those themes. For example, climate finance mitigation can be a fund, or energy efficiency can be a fund offering, where a product offering where investors who invest into the fund know all the money goes into this direction and it supports, let's say, climate mitigation measures or adaptation. Or we do sustainable food, or we do financial inclusion. We do, from an asset management perspective, we only, with some little exception, only do private markets. So we are not invested in listed stocks or bonds. There's one product where we do this, but that's more the exception than the rule. Our strengths, and 98% of all the assets, private market. And in the private markets, we do private debt and private equity. We do both. Yeah. So if you want to, in a nutshell, the company is a specialized asset management house. In today's terminology, an impact asset manager with focus on emerging markets and with focus on creating access to opportunities for people.
So of this 5 billion in assets under management, which is enormous, how would you split between private debt and private equity? Because you make it sound like you're listed debt, and I think you also invest in fund of funds, but that's very small, I imagine. So today we should really focus on private debt, private equity. About what percentage do you have?
Private equity is roughly 35%, and private debt 65, 65%.
So these other two are very, very small. And then you made a point of saying not at all on listed equities. Tell me why not?
Our vision on admission is all of our investments which we do contribute to these developments on the ground in these markets. Now, most of these countries and the companies where we need the companies to invest are not listed companies. So if they would be listed companies, that's a completely different thing. But in these countries, what we call the capital markets are not yet so developed. What we call the investee companies, so our partners in the countries, because we don't invest directly in people, we invest in companies. The partners in these companies are, to the largest extent, are private companies not yet or not listed. Some of them will never be listed. That's one. So you have to go to this segment. You have to play in the private market in these countries if you want to broadly contribute. Yes, some of our investee companies, we invest equity, and over our investment period, they list on a stock exchange. In India, for example, this is the case. We have a couple of those cases when this happens. That's a good thing, but when we want to build a portfolio, a broad portfolio, we could not build this portfolio only on listed stocks. That's one. The second argument is a different argument, is an argument which is important to make. When you invest in a listed stock, you have to be very clear. It's a secondary transaction. I mean, when you buy shares on the stock exchange, somebody sells. So that's the logic of it. It's not like you participate in an IPO. That's the exception. The normal thing is you buy shares, somebody sells. So from that perspective, your impact on the real economy is very different from when you do private market investments. Because when you do private market investment, there's a loan, for example, which goes into the company, and this loan helps the company to grow the balance sheet and to do more under their business model. And so when you look from an impact perspective, there is a big differentiation between impact through private market investments, equity debt, or impact in listed markets. To put it for people listening or interested in this, I would even go so far, look, there's nothing wrong. And of course, the majority of the investments happen in listed, in public markets, obviously. There's nothing wrong with this. It's just people have to be aware that, of course, you do that. The real world impact is very different from when you operate in private markets.
So you don't buy the arguments that through engagement, they're achieving impact?
There's two things. Yes. Let's say you do such a listed fund and you say everything comes through engage. I would say, yeah, there is some influence there, but
it's not as direct. You're saying it's not direct.
Don't misunderstand. I'm not saying there's nothing bad about it, and it's all fine. But I think one should recognize the differences. Yeah. And I think these differences, we didn't start saying, oh, we want to do private market because we think the other thing is not impactful or so. That's not our argument. My point is, in the markets where we are, we would have only very limited scope for doing what we do in the public, because public market, it has not been developed. It's not there. It's just not the same scale. And the other argument is a conceptual argument. Yes, and true. So one can talk about engagement. Others talk about, there is ESG funds and there is signaling. And between us, or very frank, no, the hard evidence is not there. The hard evidence, and it's very logic why it cannot be there, because on the other side is always somebody doing exactly the opposite. So no, that's not the same thing.
Well, between us, I won't say anything. Okay.
Yeah. I'm just saying, no, I say this also in conferences, as it has to be very clear. I think people have just to understand what is what. I repeat, there's another group, for example, there is large, in the US, but also globally, they do philanthropic approach. So they don't do investment. They do impact philanthropy. Now, it's not what we do. We do investments. I'm not saying it's wrong. No, it's a different thing. Yeah, but people, I think very often, one has to really differentiate between these different things, because otherwise it gets, for people who don't spend like we do, we spend day in, day out with this. For them, it's easier to understand what is what. And then it's all fine. We try to go quite some steps further.
What regions are you active in, and what countries do you have people on the ground?
Investment-wise, we are, as we speak today, we are investing in around 70 countries, roughly. Where are these countries? Asia, Southeast Asia, Central Asia, Africa, Latin America, also Eastern European countries. So that's the large landscape of countries. Yeah. And yes, for doing this, we need people on the ground. We employ today roughly 270 people, roughly. Half of them are on the ground, or even more than half of them are on the ground, and the other half is in Switzerland. So we are headquartered in Switzerland. And when I say on the ground, what do I mean? Yes, I mean, we have office in Lima, we have an office in Nairobi, we have office in Mumbai in India, we have people in Singapore, we have people in Tbilisi in Georgia. So we need in these locations people with local insight, local know-how, language also. Language is, of course, for us very important. What we mean when we say on the ground, to identify the investment opportunities, but also to carry out the investment opportunities. And so that's how we are structured. And each investment which we do we have a direct relationship with the investee company.
And how many funds do you have? Because I think you have a lot.
There's a lot. We have more than 15. I was saying, people say, oh, you should know exactly. But the point is, yes, look, it's a large landscape which we developed. Yeah, there is a number of funds which have the topic financial inclusion. There are a number of funds in climate, either energy efficiency, or there are funds where it gives access to energy. These are different nuances, different funds managed for this topic. Or, for example, a fund, and I just come out of a meeting with people talking about climate smart agriculture. So this is about climate adaptation investment. So it's a super important topic. It's not so easy to make it investable. And then, there's financial inclusion, there's sustainable food. Yeah, so we do investments in sustainable food, specifically, on the private debt, but also on the private equity side. And so we have developed that landscape. All of those funds are, if you want, so you could say these are thematic funds. Because what we do, because it makes things also for the investors easier to understand it's not an impact fund. These are all impact funds. But when you are an investor in these funds, I invest with the objective of access to energy in emerging markets. That's my theme. Or I invest with climate mitigation in mind in emerging markets. And there are many investors, institutional investors, but also private sector and, private people, like us, who are looking for these type of investment opportunities. And then to say, I want to have something in climate. And then it's easier to understand. It's not a mix of things where everything comes together. That's the other thing, of course, when you do in public market and listed market, basically you see an impact, BlackRock, impact fund. There's all type of companies, all type of companies there. And it's a very different approach. What we do is, as I said earlier, we identify a problem as an investment opportunity. We look, is it investable? Very important to mention. It's not impact first. So what we do is we ask ourselves, is the risk return profile good enough for the invest? Because this is very important. There needs to be financial sustainability, because if it's not there, it's either not interesting for the investors, or the company cannot provide the services over time. So it's very important to include this type of things. But as we look at only companies which have a very specific business model, you have basically the impact always built into this, because we select already the companies from the beginning under a certain criteria.
Are these funds open or closed-ended? Or are they both?
They are both. There are open-ended funds and there are closed-ended funds, depending on the topic, depending on the asset class. So there are different approaches. We structure the products, to what are the needs for the underlying, for the investment opportunity, but also from the investors, because some investors, of course, can't even invest into structures which are closed end because regulatory wise, it's not possible. And some investors don't want to invest in this. They want to be in an open-end structure. So we have to bring all of these things together to be successful.
And are any of these open to retail investors, or are they all for qualified investors?
Only for retail investors in Switzerland. And this is a very big topic. It's a very big topic on, so to say, the agenda when you see discussions on impact investment and how things could or should develop. Many people would say, but ideally, we also should have more offerings for retail investors, because retail investors also, they have an interest to do these investments, but very often there is hardly any offering available of these type of impact. Yes, I can go to the KKR or BlackRock impact fund probably, and I do this, in public market. That's a slight different thing. And many people understand this, and many people complain also, but this is driven by regulation. So because the underlying assets are not liquid, there is no daily liquidity in these offerings. And therefore, with good reasons, and I'm not misunderstand, there's good reason the regulators are very hesitant or restrictive on allowing this to be an investable opportunity for retail investors, because they are saying, but then, there can be situations where retail investors want to have their money back, and they don't get the money back because the underlying assets are illiquid.
One last quick thing. In 2022, M&G acquired responsAbility. What prompted that, and has that helped you, or will it help you increase the impact of your investment strategies?
Two things are important there to understand is when we founded the company, and this is a bit different from some of the peers, we invited from the very beginning institutional investors in Switzerland and across Europe. But let's say Raiffeisen banking system was a shareholder of responsAbility. Bank Vontobel was a shareholder. Swiss Re, it's a known brand. Bank Baumann, a private bank here in Switzerland. So we had from the beginning institutional investors as shareholder in the asset management company, in responsAbility. Of course, management also had a certain part of the shares, but the bulk was provided by these investors. And this group of investors stayed with us for, to put it simple, 20 years. Basically, after 17, 18 years, for different they had their own different reasons. They said, look, I put it like this. The company has been growing so much. We are not the right partner for this company for the next 20 years. So they said, look, we have been supporting, or we have been with the company for 20 years. It's all fine, but we can't see us in the position being the right shareholder for this company for the next 20 years. They discussed between them and said, okay, why don't we go to the market and look out? Can't we find another shareholder who's probably the better partner for this company for the next 20 years? We did this end of 21. We ran a process. We talked to many parties. Long story short, we talked to around 120 parties, actually. And it all boiled down to a handful. And we decided to go with M&G. M&G is a UK-based, very long history, asset manager, asset owner house, around $370 billion under management. So it's a large asset management house. And why did we come together? First, of course, not in my, but just we had to solve a problem because the other shareholders wanted to exit at that point in time. So we had to find somebody. We had like a really strategic idea. The idea was, look, ideally, if we find this asset, a larger asset manager, we can be more impactful together in the setup. And what that was, and we said to be more impactful is we need to make sure there's no cultural clash. After 2 years, I can say, it's absolutely fine. But of course, a large asset management house and we a niche player. So there can be differences, but I think that was very important, the cultural element. The second is, do they share our vision? Do they see what we try to achieve here? And they do. The third is, can they also help us when we launch new funds? Not in all of our new initiatives, but can they in some initiatives also anchor such a fund and do an investment? Because when we go out to talk to our external investors, Of course, it makes a difference when you say, okay, I want to launch a fund, but my shareholder already invests 20 million or 50 million into such a fund, or you start from scratch. So we were looking for somebody who also can do these, let's call it anchor investments into funds. And of course, there is somebody, when it comes to distribution, has a broader distribution network, because we are a small house and we never will have a very large sales team, so to say. And M&G, I have to say, we found the company, this partnership, where all of these things came very nicely together. And now, a bit more than 2 years later, I can say, yes, there is a number of initiatives without having that new shareholdership would not be at the same level where we are today. And so I'm very grateful. I'm very thankful for this. And it's very exciting partnership. Of course, we continue doing things together and growing things together.
It's interesting backstory. I'd like to now try to drill into your investment process that you go through. Based on what you described to me, we'll just maybe limit the conversation to private equity and private debt, since that's really the main part of your business. And we'll get into specifically impact in a minute, because you have a very unique and thorough process there. But could you walk me through at a high level what you're looking for when you're selecting an investment? So we're talking about more the financials perspective. I just want to confirm something for people who are listening who might not be familiar, but I think you're working through financial intermediaries. You're not doing direct investment.
Let me explain. No, it's very important, because this sometimes for people can be confusing. Yeah. When people say we do investments, financial inclusion, this always, there's hardly there's no exception. It means you don't go to the final beneficiary. You finance a financial intermediate, a bank, to put it very, you finance a bank in Ghana, as an example, because you cannot go to the micro entrepreneurs and say, I give you a loan. That is nothing. It's also not conceptually the right thing. The right thing is you finance financial sector players in the country, and these players provide the services to SMEs, small and mid-sized companies, micro entrepreneurs, people who otherwise would probably not be included in the financial sector. That's one. When we are in the agriculture sector, but we finance, for example, a cooperative, a producer co-op, it's also a company. And they, of course, have many people who are part of the cooperative, and the money flows there. But we go through a company, but it's a direct investment into agriculture value chain company, somewhere in the value chain. And the same as when we go into, let's say, climate finance, there are many companies we work with. They do renewable energy project development in emerging markets. So we finance this company in Thailand, in Vietnam, and this company in that country develops for other clients renewable energy projects. Many people would say what we do is direct investment. It's all direct investment, but of course, then these companies provide service and to the ultimate beneficiaries, because we cannot do this directly ourselves, and nobody would, conceptually, it wouldn't make sense.
I think it's important that when you're talking about making investments, you're writing fairly large tickets to these financial intermediaries who actually do the on-lending and make the $4,000 loan. I just want to make sure people aren't confused on that. That's what you're talking about when you're defining your investment universe. You're defining who you're going to lend to, who's then going to take your money and ultimately get it in the hands of the people or the companies that you're trying to help. So how do you define your investment universe?
This is exactly defined by the impact theme. Each fund or product has, as I said earlier, has a theme, or it can have two themes, but there's a core theme. And these core themes define the universe of companies we are talking to. Because when I talk about energy efficiency, I have a different theme compared to sustainable food. And this is a different universe of companies. Now, what we do is we identify the theme. Then we have a certain range of companies in mind with certain criteria. And then we reach out into the markets. We look which companies are out there and which companies do fulfill our, if you want so, impact criteria. That's the very first question. And we look at these companies. And then once we have identified, we think, okay, this company could fit the equation. There comes, of course, the whole financial analysis, because they might fit, but they are not a financially good investment. So we have to look into this, of course, indeed, like any asset manager. And we run all of these investments also under what people would say, we do environmental, social, and governance check. So ESG checks. But this is for us, it's not, so it's just a necessary requirement. Every investment goes through an ESG check. It's nothing which we use as for positioning. So we do this all the time because we have to do this. But it's not enough for us, because for us, the companies have to fulfill also our impact criteria, which are not the ESG criteria. That's a different set of criteria, which the companies have to fulfill under the specific impact theme of a certain fund.
But your first cut at all this is more traditional finance.
Two things come at the same time. We look financially, and if the company is financially not sound, we cannot do it. I mean, it's just that there are limits. And the second thing is, at the same time, we look, but does the company have, in my terminology, a business model which is in line with our impact thinking? Because if the company doesn't have that business model, it also doesn't help us. So we need to bring these two things together. Yeah. And luckily, on these three themes, there are many companies out there who tick these boxes. Sometimes, and we have quite a bit of this, where we also approach account and the company might not be yet there. They have to learn the business model. Then we can use from time to time, we have also funding from governments, which we call technical assistance, capacity building. So where we can, and we have a specialized team for this, where we can support a company in developing a business model. But that funding doesn't come out of the investor pocket. That funding comes out of other pockets, which are provided by governments typically, where they approach us and say, look, you have outreach to so many companies. So we are willing to finance and to support companies also on a different level.
And what are your typical ticket sizes?
Per year, we do between 1 and 1.5 billion. So it's basically an average 5 million average. We go down, we do also 2 million tickets. So we did in the past, even $100,000. We don't do that very frequently these days because that gets very, very problematic. No, too small. And it can go up. I mean, there can be tickets of 20, 30, 40 million. Yeah, that's also in the range. So it's not all centered around 5 million because it depends on the investee company. So when it's a larger company, which can absorb also larger amounts of capital, or for example, in the climate, when it's kind of infrastructure light, ticket sizes can be bigger. So it can be a 20, 30, $40 million.
And is this ticket size more or less the same, both equity and debt side?
No, on the debt side, depending on the top, we can do even smaller tickets. On the equity side, these days, on the equity side, tickets have a tendency to be a bit higher. Why is this so? Because the private equity process and the involvement with the company is very different from the private debt side. You know, on the private equity side, you are a shareholder. The fund is a shareholder and we represent the fund, and the involvement and the working together with that company is intense. When the ticket sizes are too small, it's very difficult to cover cost. And again, here comes the financial sustainability aspect. We also have to make sure that our own business has also to be cost covering. We cannot subsidize this. You know, we have to say, okay, and therefore on the private equity side, ticket sizes have a tendency to be a bit larger than on the private debt side, but we are not talking, you know, there are some investment topics on the private debt side where also tickets are larger. But for example, when I talk about sustainable food debt, then there are investee companies in Africa or in Latin America. So they are relatively small. So they might get a ticket of 1.5 million, let's say. And so therefore the tickets there are smaller than compared to other investments.
And your equity investments, do you have an exit strategy for these? Or do you have a holding period?
We do have holding period, like let's say we operate there, if you want, so like any other private equity, emerging markets. Huh? I mean, there are two things on private equity, which is very important because otherwise people will be confused. The private equity we do is there's no leverage. I mean, it's not like a classical US or European private equity fund would use quite a bit of leverage in it. We don't use. It's basically the money which we have in the fund does direct growth capital investments in this company. So it's very important to keep this in mind. The second thing is very often we are dealing with countries where the exit cannot come through the capital market because there are no capital. In some of the countries, there are no capital markets. That means we have to do trade sales. So we look for strategic investors. And so yes, we have to think about exits from the beginning when we do an investment, and we do. However, the reality is, and I'm happy to share this, of course, geopolitical situation can change, for example, and suddenly your exit strategy is very different from what you thought because it's just not the same environment. So that is something which, we have to be prepared for dealing with this, but we know exit, and it's not only with us, it's true for other managers who do private equity in these countries. Exit is a topic and it's a lot of work to make it happen.
And what are your target returns for these two asset classes?
On the private equity side, we are really competing also with private equity, growth private equity funds. It's just that our return doesn't come to, through the leverage because we are not using leverage. Yeah. But we are really using commercial returns there, for because that's what we also see what can be achieved. When it comes on the private debt side, one has to differentiate which topic. And this is market condition. But I can give you the first, the very first fund, when you talk about the financial inclusion product, just, like 20-year track record. So typically you will see then that return in US dollar over the years are around 4%, roughly. Now we have a phase with high interest rate that as we speak, returns are higher because interest rate levels are higher. So you have higher returns, you have returns above 6% or 7%, in that range. But of course, when you have an interest rate environment over 20 years, where the interest rate are much more lower, then also our returns are lower because that's the environment which determines this. But the range you have to imagine, it depends on many factors, but from highly diversified portfolios, which are in these ranges, then it goes more concentrated portfolios where you are more in the 7 to 10%. Then you are more in the mezzanine financing. You go into different or more equity-like, and then you are more between 10 and 15%. So it really depends on where you sit on the balance sheet and on the concentration in the portfolios.
I would like to now drill down on impact, and I feel that responsAbility has a unique approach. And if I've done my homework right, there's like 3 layers. The first is incorporating, as you've already referred to, an ESG assessment for risk mitigation. And secondly, there's an impact assessment that seems to assess impact capacity. And then lastly, there's an overlay of technical assistance and advisory to maximize results. I presume this is something that's proprietary that you've developed over the years. Is that true? And how was it developed?
It's not like there is not one unified approach for each investment. There are certain elements which apply to all investments. All others, you mentioned the technical assistance, is not applied in each investment. In some, but not in each. So the framework is this. First, do we have on each fund product a very clear, well-identified impact objective? Yes. This defines the universe of investable counterparties. When we do then go into the process and analyze, we see whether, and this is a long list of criteria, depending on the topic, does this counterparty fill that equation? Some do better or not so good, but is our minimum achieved? Yes or no? That has to be looked at. Then comes the traditional ESG assessment, environmental, social governance aspect, which we look into, where we also have to have a clear picture. Where does the company stand on this? And then comes also parallel to this is what I call the financial. It's very important to mention the financial analysis is super important. Yeah. So for us, like as we are, you could say, so your responsibility is a thematic investor. Yes, we do themes. So therefore, the understanding of what do we try to achieve with the fund is driven by a theme. And this makes it easier to apply a set of criteria, because when I talk, for example, about financial inclusion, I think we have such a broad, deep understanding of what we are looking for that we can be very precise on which practice in financial inclusion is for us, so to simply speak, a good one or not so good one. And to differentiate there, what do we want, where do we want to be, and where do we don't want to be. But that's something which you develop over time, over years. And so we have this and develop this, of course, for the 3 topics. And each new topic which comes up or might come up has to go through a process of developing these criteria, because the real critical things are in the nitty-gritty there, in the very specifics of a sector. And it's that can be very challenging and very demanding.
These authorized funds, or the criteria list, there's, I presume, established when you set up a fund.
Yes.
But this incorporates both the financial ESG assessment as well as the impact assessment, right? It's a combination. It's not iterative. It's not one or the other. So then in the impact assessment, you give each of your prospective investments an impact score based on something you call the 5 dimensions of impact principles. So
we can, when we have a system, where we score, there is more, but this is, if you want, so more fast for the internal processes, you see where the companies are. But the very relevant part is there are typically in the different themes that there can be situations where you find out something about the company where you say, no, this, even the other scores are good. The other parts are good. They are scoring high, but they are missing one element which might override the whole score and say, okay, no, this is not good because of this specific problem. And therefore, scoring, one has to be careful there. We do this, but it's not so simple that you say, just a score and it comes out, because specifically, when you get into a business model design and you get one element not right in it, that can be disastrous. And therefore we have to, be flexible in the interpretation of this. And that's the way we do this. Yeah. For example, when you pick financial sector, financial sector developments is sometimes criticized. Oh yeah, of course, it can lead to over-indebtedness. You provide financing to people. This can lead to over-indebtedness. That's a problem. And we are very aware. So therefore, it's super important for us to understand what is the analytics this bank applies to deal with and to avoid, to mitigate these problems. So we have to understand that part. It's a very important part. And so we design these type of, criteria because we need to know that when we invest at that point in time, we think they are doing the right thing. Things still can go wrong, of course, and we have seen it. The companies can fail for many reasons, but we want to see that, the approach is an approach where we say, look, it's for us, it's good enough to see that this company qualifies under our criteria.
If I understand you correctly, it's not really like you have these 5 dimensions and you come up with a weighted average score. It can be missing one thing that knocks the whole thing out,
yes.
Right?
Yes,
right.
We can have these scores and averages, but I'm not a strong believer on the averages. Important thing is, are the key things fulfilled, yes or no? And there we dig deeper.
Once a company has passed this stage, then you move to the ESG assessment.
Yes, it always follows, and it basically, the things happen in parallel. We look into this. And again, on ESG in emerging markets, you might find, I take, for example, governance. Let's take governance as the G. You might find a company where you say, whoa, there on a governance level, there are some question marks. They should improve. Now, the question is, do you exclude the company, or do you say, oh, the company probably wants to improve on governance, so can we use also our financing to push the company in the right direction? So you see, it would be too simple to say, oh, the company scores low on G, oh, we can't invest. So as we are in development investment, so we try to develop things. It's very important to understand that you cannot just say no to everybody, because we would find a lot of no's easily. We have to see, okay, but is this a partner? They understand where we come from. Why are we asking the question? They understand it, or they see, okay, here's something we want to improve. Can we include it into our collaboration? It can go even into a loan contract. And there are different ways of doing with this, because we want to basically, we are partners also in their development. That's a very important part. Yeah, it's not just simple saying, okay, we invest, we don't invest. It needs all of this.
A lot of these companies, in fact, all of them are privately owned companies. So this isn't in developing countries. So this isn't as simple as going to MSCI and getting ESG data. Do you have to collect your own data, or how does this work?
I very often say it's handmade. So what do I mean by handmade? It means, yes, there is somebody of our people reaching out to the company, collecting that reaching out means visiting, doing due diligence, or all these type of things. Of course, once we have established relationship, things can be also done over calls and sharing information. Yes, we have to collect the data. We have to do the assessment ourselves directly, because we cannot buy this data on the market.
So then you've got this impact assessment, ESG assessment. Then what happens at that point? Then it's time to decide.
Yes, then it goes always into different process. Let's say put it simple, investment committees. People look into this, and the decision is taken. Yeah, typically this process can be longer, depending. There might be some private debt deals where we already work with the company for 10 years. We have some clients for 10 years. Of course, the process is easier. You do the third transaction with the client. We know each other. It's different. Right? It's a new client, or you do an equity investment. Process goes much slower. It's much deeper analysis. It takes much more time. But that's what we do, and that's what our investors pay us for. To spend time with the companies, to put our know-how into this and say, look, we looked into this and we come to the conclusion this is a good investment under this topic. And here we go. And then we invest. And when we invest, of course, when it is a loan, there is always information flow over the term of the loan. When it is an equity investment, we are typically, of course, actively involved, because we are, for example, on the board of directors of that company, basically in most of the cases where we invest. That's a very different level of engagement. Yeah. Just to mention, and I didn't say this before, and I don't want to confuse people, but we do also, with one line of business, we do fund investment. So we do really, in your terminology, probably it's called indirect investment. So we invest into other funds. So like a fund of fund approach. There's very deep engagement with the fund managers, but it's again on a different level.
And you have advisory team that supports these companies once you make an investment.
Our people on certain topics now have also broad insights, and they can share a lot of best practice. And so, but there might be situations where basically we see the company has a need in a very specific topic. We cannot afford to have a huge advisory team, because we cannot afford. But what we typically do there is, over the years now, of course, we have a broad network of consultants. And so you say, this company has a very specific need on a very specific topic. What we do is kind of look, hey guys, you can work with these type of consultants. And we bring in the consultants very often and say, look, these are the guys you can work with. And so this is actually an added value for the investee companies, which is highly appreciated. Because imagine we have the big luxury. We see in 70 countries, 300 companies, we see a lot across the country. And of course, when I sit in let's say I sit in Indonesia, I know locally what's happening. I don't know what's happening in Peru because that's very far away and it's a different world. And so the access to information, how are people dealing with this problem in the other parts of the world? That know-how sharing is a key part of what we do also with our partner companies.
You've talked about these partner companies. We've just been through your whole investment process. Could you make it real for me with maybe an example from the private debt and private equity so that people listening could understand exactly what kind of company you're investing in or lending to and that they're on lending or on investing?
For example, if you take food, sustainable food, equity, imagine there's a company in India who has built a network of thousands of smallholder farmers, collects basically their production and then processes and distributes the production of these smallholder farmers. So what's the topic there? There are two things. Smallholder farmers, including them into the formal economy, that on one, food production. And the other thing is this company, for example, I have a company in mind which I like very much because they provide training to the smallholder farmers on sustainable agriculture. So through that investment, we basically achieve that sustainable practice is applied on a much broader scale in this case, India and Africa, but they do it in both continents, India and Africa. And so that's what we like about the company. So it's a very concrete case. What do we do there? We do equity and we could also do debt and put that debt. So both are, but that's a very concrete, another one, if I jump to make it concrete for people. Imagine you are in Vietnam and you are working with a company who specializes in renewable energy projects. What they do, and we have quite a number of those, they work with local companies in Vietnam, in the region, who say, okay, I want to do a solar power installment on my roof, or, what we call commercial and industrial renewable production. So C&I. So this company has specialized in identifying locally companies who want to invest into renewable energy. And this company needs financing because they buy material and then implement for these companies renewable installation, which contributes to have a better energy mix and to avoid CO2 emissions, because otherwise this renewable energy would not be available. So we then finance long-term this company, that this company can operate and do more renewable energy installations in the country, as an example.
Once you make these investments in companies like you've just given us examples, how do you track their impact post-investment? Do you have KPIs? I imagine they're different than the ones you maybe analyze them on. Maybe
it's not so different. The KPIs for a renewable energy production, installation company is different from a KPI from a smallholder farm. It's different KPIs. But we basically know what is key. And I'm a friend of simple approaches. This is already what we are doing is complicated very often. So it's very important to understand what are the key metrics which really matter for achieving an impact. For example, when you are in mitigation, you want to see that a certain amount of solar installation has been implemented, because this will contribute to renewable energy production. It's a chain which you can follow, and exactly when this is. The sun will be shining. Yes, you still have to make sure that are these installations in operation? Yes, no. I mean, you have to make some checks, but when this happened, and you will get the impact which you are looking for. Climate is sometimes the easier one. When you work on inclusion or things can be more complicated, but what I only, and what, is, to be very frank, in the whole industry, most of what is done when it comes to impact measurement is output measurement. And it's very important to understand there's nothing wrong with this. That's okay. I'm offering insurance services and, okay, how many people do I reach? That's an output. That doesn't not anything say about impact. It's just, there is a new opportunity and people are using it. Very important, Scott, to understand. People buy the service. Now, when you buy an insurance, or you buy, if you want, so you take a loan, you pay for it, or you open a bank account, but you pay for it. Now, very important, poor people, if there would not be a benefit for them, they would not buy the product. You have to really, and therefore I'm so much insisting on, as we are not in philanthropy, as we are not in subsidy and donation, we are talking same level, we are talking partnership. And when people buy a service, that's in itself already a very strong signal that there is a benefit. There is a benefit coming out of this. Otherwise, they just would not do this. And of course, the analysis doesn't stop there. But what I think is very important to understand, it's a business relationship. People have new opportunities which come through this offerings. Now they demonstrate that they are using it like a mobile phone. I mean, who buys a mobile phone? You can then say, you are doing this because, yes, you want to use it for certain. And that's the same thing on these basic services, because people have to buy these in most of it. And there's no an insurance system available and you just go to the doctor. Typically, even when it comes to healthcare, people have to pay for this. Now, this signals the importance of it. And therefore, in the measurement, it's super important you identify these key points, which are important, which give you an indirect indication. Now, after the indirect indication, and nobody is capable of saying, okay, now we measure what did it do with the people? I mean, if you want the outcome, or even when you go one step further, the impact, it gets on the measurement part, it gets much more complicated. And yes, it's useful to do here, there to see whether the mechanic works in the right direction. But otherwise, it's very important to keep it also simple and to keep it efficient. Because don't forget, I typically ask investors, I say, yes, you want more impact measurement. We can do it. It costs you 15 bips extra. Guess what? The answer which I get very often from investors is, no. Then we keep it simple. You see what I'm kind of the point is, there is cost involved. And somebody has to pay for that cost. Therefore, we really emphasize a lot, it's very important to keep things manageable. Because if it's not so, yes, you might have a better feel or more complete picture, but the reality hasn't changed. It's just very costly exercise at the end. So we are very sensitive there.
In some of our correspondence together, you've referred to decreasing impact as a success factor. Tell me about that.
Our ultimate success is that we are not needed anymore. I mean, we are not. It's very different from, let's say, I'm just looking at an iPhone here, and I look at Apple, and Apple's fine. I'm not blaming anyone. It's a different business model. I basically want that tomorrow my clients again buy iPhone number 17, 18, 19. They continue the journey with me. That's what they do because that's my success. In our case, it's different. In our case, it's, of course, look, it happens over long time periods. But ultimately, the success is, but people have access. Ultimately, that we want to get there. That's where we want to get. So you see, for us, success is not, people depend more on us. No, they should depend less on us in the future. Now, we have business orientation. We do business. We want to grow. Don't misunderstand. This is very clear. But you see the fine line. The line is, look, it's not about creating long-term dependencies. It's about creating local systems which contribute later so that people, and these problems, so to say, are solved. I understand of course, it's clear, it takes very long time, but I think it's very important to keep this in mind because it's not a good approach for what we do. And, like say, okay, but we try to basically make people dependent. No, they should not be dependent on this. They should do. And therefore, sometimes I say, look, and I get in some conferences a question, people ask me, but Rochus, but is now not the impact decreasing? I say, yeah, that's good news. Because when a market develops and a problem over a long time period basically gets more and more, let's say, solved, obviously your impact is decreasing because the problem is disappearing over time. So that's a good thing. But you see where we come from, what we try to achieve here. But as these things happen over long time frames, it doesn't matter. Right now, the need is no. Some investors that say, but Rochus, why should I still invest with you when the impact is decreasing? I say, no, it will decrease over a long time. There are 500 million people without access to energy, to electricity. There are still 700 million people without access to financial services. It's still there, the problem. But you see, philosophically speaking, over time, there will be a moment where, of course, it should be less. And hopefully, when I talk about climate, hopefully in 15 years, we say, wow, we did a big step forward. And now there's still investment need, but it's less of a pressure than what we had 15 years, hopefully, because otherwise things will not look good.
How do you manage the risk when a company is not achieving the impact that's expected?
There are two, again, when we do private debt, a loan is for 3 years, let's say, and we observe and we see, okay, it's not, then we don't extend the second loan and we stop the business relationship. When something very bad happens, which also could happen, we could recall the loan and say, look, please, pre-repayment. That's also a measure which I can, when things really would go in the wrong direction. On equity investments, you did an equity investment, but you can also influence it because you're a shareholder. So when things don't go in the right direction, then our people have to actively, of course, involve. And I mean, there's constant involvement, but specifically then there have to be involvement on this and say, okay, here, now we have a situation, we have to bring the company again into the right direction. So you can be ultimately, when it's not feasible or so, then you only can exit. But that you have to find a buyer for your stake.
How does responsAbility think about impact and its relationship with financial returns? Have you found impact results always to align with or correlate with your portfolio's financial returns? And of course, we're talking about positive impact. Is there a linear correlation between the number of lives positively touched and the investment's financial return?
This is a complex topic. Let's say there's one bottom line there. When you invest debt or equity in a very successful means good business model and the company grow. And we have a lot of these companies, they grow very strong and have this business model. They are financially super successful. I mean, it's when you're an equity investor and a company is growing very strongly, profitable, that's a good financially a good investment. It is also by definition more impactful because it has a much bigger outreach. It contributes more. That's one line I think, but it has to be very clear. A company which has a super, let's say, beautiful impact model, but stays very small, very tiny. There's nothing wrong with it. It can even financially be okay and it's fine. But one has to be very clear. It's still a limited impact. Yeah. The biggest impact, of course, to be very clear, is when a company demonstrates something and it is replicated by others. And very early in our talk, I said this enabling environment is of course, is very impactful, but that's not an investment activity. That's creating an enabling environment, very, very impactful. When it comes to investments, sometimes in a country, you can have, and we have, I feel very proud also about, in some countries we get also in this, so to say, nice position. We bring a new topic in a country, we find the company, and the company says, okay, now I do an energy efficiency offering in the market. And it's the first energy efficiency offering in a market. The competitors see, oh, this is actually a very good thing. And a lot of clients go to this, in this case, a banking institution, and then they start to replicate this. Then, of course, you see, you basically move the needle with one investment in the market. That's where the biggest impact comes. Of course, these are more, it doesn't happen all the time. Not all the investee companies can be in such a position. We don't expect this. But you see, there is a lot of it. Now, your question is impact and return. Yeah. Look, growth, yes, a strong growing company has, by definition, when it has a good business model, also larger impact. And that just comes by the numbers. And it is the case there. But, like for us, super important is, look, there needs to be attractive return for the investors with the investment. Because if there is no attractive return, tomorrow investors will not invest in this. And then also the impact will decrease. Like you need to basically complete the circle. You have to do an investment. It has to be from an investor perspective. And investors are not only looking for the financial return, they also look for the impact they can have. But of course, the financial return is a necessary requirement. So they need the return. Think about a pension fund. A pension fund needs a certain return because that's a fiduciary responsibility with their pensioners. So they need to do this. And so you have to complete the circle and to provide, if you want, so that return. Therefore, we combine it with this business model where we know impact goes also with growth and with return.
But there was a day when people felt that to achieve impact, you have to sacrifice financial returns. But you're arguing that's no longer the case.
No, my argument is slightly different. What I'm saying is, look, let's say there is an investor who wants to do private debt. An investor comes and says, okay, I'm not so much impact. I want to do private debt portfolios. Are there more attractive private debt offerings available compared to what the impact, not only us, let the impact people do in emerging markets? Answer is yes. I'm very frank, like I'm saying it's very important, like what we do needs to be attractive. I mean, it needs to be also financially attractive, but I'm not saying, look, when an investor just goes for maximizing its return, and everything else doesn't count. I'm just interested in maximizing my return. Then return means risk return. There is, of course, good arguments because some of our private debt portfolios are highly diversified. They have very low volatility. And when you have an investor who says, I want to avoid risk, then they see, whoa, the beauty of these investments. But you see, the question very often in talks is put forward a little bit too simple. An investor is not only looking for maximizing return. For example, private equity. It's probably simpler for people to understand. Yeah, but when I want to maximize return, I go to a private equity house where I probably use a lot of leverage because that might boost my return. When you do, like we do private equity without leverage, you are building on the growth story. Yeah, you get attractive returns, but it doesn't have this element of leverage. So if you compare these two things, now you can say, but the leverage is also risk. I'm comparing apples and bananas, so it's not the same thing. But you see what I'm saying is important is, are these investments which we do financially, risk return wise, attractive offerings for many people of private sector? And yes. Are there people who have other criteria and say, no, I want to have even more? They would then not invest into these type of opportunities. But it fulfills the equation of being attractive opportunities.
I'm going to switch gears here and just cover a couple other topics with you. The microfinance space, which responsAbility's started out in, has not been without its controversies since the beginning. In fact, I read a pretty extensive critique written by Bloomberg only a couple of years ago in 2022. I wanted to ask you, what lessons have been learned in the industry? I'm not saying necessarily you guys were implicated in anything. And then have any adequate safeguards been put in place as a result of some of this that has come to light?
Don't misunderstand me on this, but what people talked about, let's say Bloomberg for 2 years ago or others 5 years ago, we also discussed 20 years ago. It's not, I have to say, And I can say, because I'm in this for more than 30 years, I tell you already there was over-indebtedness in Bolivia 1995 due to specific market circumstances, which I don't go into. So what I'm saying is financial sector development, and I prefer the term instead of what we are really doing here is financial sector development from below is inherent. When the financial sector develops, there can be overeating. Now, I'm not saying we should not care. I'm not saying this. I'm saying be aware. You develop a financial sector, they go through these cycles of faith. That's what you also see. I mean, I'm here in Switzerland. We had the same thing in Switzerland 20 years or 25 years ago. It's not like only in emerging market or only that it is a phenomenon. I mean, look at, and I don't want to go even financial sector crisis 2008. I mean, financial sector has these elements, and that's not different. Now, the very specific thing is, but we are dealing with poor people. We are dealing with people when they're even hurt more. So it's very important that the standards the institutions which we partner with, that they are aware about this and they act upon this. So therefore, there are these things which can go wrong. Absolutely, and it should not be the case. I mean, it should not. It should be avoided. But we are talking about millions of people. No? We are not talking about 500. We are talking about millions of operations. Yeah. And then, therefore, it's very important. And what we do, and where we spend a lot of resources internally in analyzing. Okay, where are these markets? Are there signals of overeating, for example? Where do these markets stand? When we see this, we also drill this down on individual institutions, because there can be a market which is not overheated, but a single player doesn't have what we call good lending practice. They don't have this. That is also dangerous. So therefore, we have to analyze the lending practice when it comes to lending money. We have to understand where the market development is. And yes, I give you just an example. There have been recently also in press, and Cambodia is a market which for many years was a star, so to say, but now it is in the phase of real overheated. It's an overheated market. So what can we do as an asset manager? We reduce our exposure, and we basically, for example, right now we hardly have any exposure in Cambodia, which is a pity because there is need still out there. But we are saying, no, it's not right now. And we are saying, no, we are not doing basically now lending operations in that country in that current context. But, when it comes to critical points on, in my terminology, financial sector development, or people say microfinance, let's say, one has to differentiate. One is an inherent thing of just financial sector. And unfortunately, this is part of financial sector and we have to be aware about it. Other thing is a different one. There have been many people many years ago and also today, and I would say, microfinance, it's all about poverty alleviation. I mean, it's about, and here the point is one has to be very careful. Like, believe me, there are millions of people, they really improved their life through microfinance offering. Absolutely. Is it true for everybody? No, it is not true for everybody. I tell you, this is not, I for hundreds of people on the ground, I say there's differences. But my point where I'm coming back is, who am I sitting here in Zurich? It's a very nice place, saying, there's a risk, and it doesn't always do the trick, so to say, but let's stop the whole thing. It's a bad thing, because I know from the hundreds of millions of people who benefited from this, I think it's just not fair to even say, no, let's stop to give these people the opportunity. Because if you would ask the people what they want, you would say, hey, I want to have that opportunity. And I think, therefore, sometimes, when people analyze this, one looks a little bit, it's okay, it's all okay to do this, but one looks a little bit, or one puts the stake too high. What we are interested in is this creates, and I repeat myself here, access to an opportunity for people who otherwise wouldn't have that. And that is a very strong element, and where I would, after so many years being and having seen all type of problems in the sectors, in different continents, everything, my conclusion still is, look, this is the opportunity which we create, or which created through this partner institution in the country, is worth all the effort. It's absolutely needed. Now, so it would be for many, many, many people. Without that, it would be a very different life. And there is a real world impact.
I guess the safeguards really amount to the partner companies that you work with and your monitoring of them and knowing your partner. I know the word greenwashing doesn't directly apply here, but the concept does, and maybe it's more like impact washing, but maybe there's MFIs or other players that I don't know exactly who that might be trying to appear socially responsible and delivering positive impact from a marketing perspective when in fact they're not. So how does responsibility protect against greenwashing or impact washing by these underlying partners that you have, that you, because your business model depends on them deploying the capital that you're investing or you're lending to them. How do you ensure consistency in measuring results of these partners across your portfolio across the world?
Yeah, it was good. I come back to what I already said, is the analysis which we do on these counterparties. And of course, and we have seen this in the past, I'm very frank, you analyze it, you think it's all good, you do an investment, and you find out, no, it's different. Then, and I said earlier, well, then you have to basically say, okay, either I recall the loan if I can, or there's no further investment. Things can go wrong. But the safeguard or our duty is we have high standards, and each investment go through this analysis of high standards. And we can look the investors into the eyes and say, look, we looked into this. This is our practice. For us, this is good. You know, it's a good case. When then things go wrong, is then the question is it something? Very often, is it in the sector with something which goes wrong? Okay, is it really in the investee company? It happens also in a single company. Things can go wrong. The good news is, when you talk about financial sector, and I mean, agriculture is, I can talk about agriculture. And so financial sector is now most of the players are regulated. There are other safeguards. It's not, things can still go wrong, and we can still have the wrong impression, but there are other elements which support basically. But it is this direct relationship with our people have to these companies, and observing how they really behave in the market to see, do they fulfill our criteria? And once we would find out this actually we got it wrong, then we have to take the actions which we can take.
Rochus, I've got a few last rapid fire questions to wrap up our talk here. So just give me whatever comes to your mind, or if nothing does, then feel free to take a pass. That's okay. If you had to name the one most important challenge in the impact investing space at this time, what would you say it is?
If we could solve the liquidity issue, because all the offerings private markets are illiquid. And what would be a big step forward, finding solutions, not easy, finding solutions also with private market, but more liquid offerings, so that gets more accessible for a broader group of investors.
Does this mean more retail?
Retail. There are many young people, when I give speeches, or people come later to me and say, Rochus, I really like what you do. I went to your web page. I want to buy the fund on my phone. Where can I buy the fund? And I say, you can't. You see there is interest in this, much more than what we can reach out today, but because, and again here, that it is not regulatory-wise so easily feasible. I get the point. I understand all of this. But I'm saying, if you ask me, that is a constraint.
What do you know now about impact investing that you wish you knew in the early 1990s when you did your first impact investing consultancy work?
What I would have loved to know earlier than, not 1990, but much earlier than is everything what we do takes very long. That's I see now. Now, I was 20 years back, 15 years back, we embarked on very innovative things. And I convinced people, and we together convinced people, hey, that's a good thing we do it. What I did not know, and I learned over these long time periods, all the people I have been talking to change. New people come in. I mean, it's a very simple thing, but I did not reflect upon this. And it's a real challenge because you constantly are confronted then, and you have to basically, the innovative thing which you try to do to explain to new people. And very often you end up that you later give up on the innovation because the new people will not say, no, this is not what we wanted. And so it's actually learning kind of, look, you have to really think also long ahead what might happen over the next 10, 15 years with your people, the partners. And I mean investors. For example, investors, you have new representatives of investors and they have a new idea and you start from scratch. Innovation, it's an important thing, but in the impact space, real scale and getting things done faster is a big topic. Yeah. People prefer to talk about innovation because it's just nicer to talk about innovation. But the thing is, we do not have to be more successful always to innovate and new things. The replication of known approaches is actually something where as an industry, we are not that good.
You don't have to name names, but can you describe to me an investment you made that you were convinced of at the time you invested that it ticked all of your impact boxes, but in the end it didn't turn out? And what was the lesson learned from that experience?
We were really sometimes enthusiastic about an investment. We did the investment and then we found out people where we thought we have a good partnership from our perspective. It was not. That's a part which happens, but that's a thing which sticks to my mind.
What was the lesson learned? Obviously, everybody has that idea when they get into business with them. Did you learn something you need to do differently to be able to judge their character better?
What's interesting there, we did once a couple of years back, we did a systematic analysis on cases to find out. And very often, not always, but very often, there was one part of the business model which was a bit opaque, where lesson learned is where I would say in retrospect, we didn't spend enough in digging deeper into this small part, which was only a tiny part of the business. But that brought to fore the whole thing. Yeah. And we didn't spend on the tiny part sufficient time. And I don't know whether if we would have spent more time, whether we would have found out. Or whether we would have made a different decision. But that was a lesson learned that when you have something there, and it can be tiny, this is my point here. Overall, the things looks great, but there is something that we really don't get it fully. To dig deeper in that part.
That seems to link back to our discussion of the 5 dimensions. And you said it's not an average score. If you're missing one, maybe that is enough to take out the whole thing.
I'm stressing that point again. That's a very important point. Yeah, I'm not so much a friend of averages there. There can be something which is wrong, and this can be really bad.
On average, we're all good.
On average, we're all good. Okay, yeah, but...
Now the converse of that, can you describe to me an investment that you had some level of skepticism, either at the time you invested or maybe you ultimately passed on the investment, and in the end it turned out way better than you thought, and you were pleased you invested, or if you passed on it, you wish you hadn't? And what was the lesson learned from that experience?
There was once, and I say it's a personal because I was directly involved. It was a time when I did still myself also investments that more or less directly. And there was an investment, in India, which my gut feeling was, whoa, very good. We didn't invest, and I still, sometimes I think about it today. We didn't invest because it was not really according, it didn't fit into one of our funds perfectly. But I think I could have made it, I could have pushed my investment committee to say, hey, let's do an exception, so to say, which is sometimes very good. This investment would have been very, very good investments, which we didn't do because we stick a little bit too much to just, okay, didn't fully fit it, the things which we had in mind. But now looking back, I think it was a wrong decision. And sometimes I really regret this, because it would have been on the impact side, but also financially on both sides, very good investment.
Did you change the way you evaluate things based on that, or what's the takeaway from that?
I don't have that very often. It's sometimes, when you're still doing the investment case, you might have a very strong gut feeling on. I mean, you see also everything, but is the lesson learned always trust your gut feeling? No, that's not what I'm saying. That's not what I'm saying. But there can be, I think, specifically when it's let's say, in this case, it would have been a relatively small investment. I don't know whether there is a clear lesson learned on this, but I know still that I sometimes think about it. I say, after 10 years, more than 10 years, I think about it. Why didn't we do that investment? Yeah, but I come back to the reasons, these reasons.
And lastly, if someone wants to get into the impact investing space, where would you advise them to start?
If somebody says, I would like to be in impact investment, but you have to make sure you have to bring something to the table. And we do investments, and they know how about investment practice on all time. There can be different type of things. People who do investments, people who do fundraising, people who do structuring. So, but I think sometimes I say this very often when people come to us, they're interested. Let me put it like this. Sometimes people imagine something different. We do investment. We are a professional asset management house. Yes, we do impact investment. That is true. But the core of it is investments and asset management and product structuring. And I think, therefore, I can only give the recommendation to young people, say, I would like to be that. Yes, but learn about these type of things, because they are needed in the impact space as they are needed also in other. So therefore, it's very important not to think impact investment is something completely different. No, it is an investment activity, and therefore investment know-how across the whole value chain is the entry point into the space.
So would you advise first to go to some, not necessarily an impact house, but first go to a major bank or investment bank?
That part is very complicated to answer. I think we have people here in-house who started basically with us, and they developed and you learn all of these types of things. But we have also many people here in the company who work for large banks or investment banks or other asset managers. I don't think there is the golden thing there. But I think what is very important to learn just the key core practice of what are the issues, because as I'm repeating myself, we are an asset management house. Therefore, the core know-how is this. Learning about what does it then mean specifically doing impact, and that's an old, and of course, then you need to go, but you have to get into this when one has to ideally, or one starts really as an intern or something, and you just look around for the first time. But I think it's good to have also, some really good investment practice as a basis, and from there to take it forward.
Rochus, you've been very generous with your time today. I've really, really enjoyed this. You are a true impact warrior. You've been there from the beginning, and you're still fighting. It was really good talking to you. I've learned a lot.
No, thank you very much also for your interest and your questions. And yes, I'm, after even now, it's more than 30 years. Yeah. And still there is a lot to do. Though it is not the easiest thing to do, but it is a lot of fun also. And there is a lot of learning, and it's very rich experience, because we have so many interesting partners and organizations. One can only be thankful for this. So, but thank you also for your interest.
Tell everyone what's the best way that they can stay on top of all the great things that you guys are doing.
Responsibility, it's on, of course, there is LinkedIn. I'm not the warrior on LinkedIn, always posting, but, there is, of course, a lot of posts that people will find, through the web. The typical, I think, electronic outlet, there's no problem.
And I think you told me you don't do social media, but what's the best way for people to contact you?
But people can, of course, people can also go traditional ways, just send an email, send also a LinkedIn. That all works. That's fine. And we are large, we are a small company, but there is also for people, in different regions. So because we have people in the regions, but can also reach out to a regional office and say, hey, I came across this, that's interesting. I think there's plenty of ways of doing this.
Great. Rochus, thanks again.
Thank you so much.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.